Hi everyone, I'm James Harte from LittlefishFX.com and thank you for joining me for this week's live market analysis session. So in these weekly sessions, what we're going to be doing is taking a look through the major currency pairs, talking a little bit about the fundamental developments over the week and the week to come, and then assessing the technical outlook as well. So if you have any questions during the session, please just write them in the chat function and I'll stop periodically to answer them. Okay, so kicking off first of all, once again, with the US dollar index. So if you remember from last week, we were saying that the dollar at the moment is caught at this big monthly double bottom. We actually saw that key reversal candlestick on the weekly charts 2 weeks ago. And from there, we've been bouncing higher. So we had the release of the April US CPI data later, the inflation figures for April. They came out in line with expectations. I think markets were a little bit disappointed actually that we didn't get a beat there. And with the way that US data flow has been recently, it's probably going to take more than an inline print on data points like that to provide further upside. However, the US dollar is deriving strong support at the moment from various Fed speakers. We had Rosengren last week noting that he thinks the market is probably underpricing the 2016 rate path. And then just yesterday, we had Fed's Williams saying that he thinks conditions are lining up for the Fed to raise 2 or 3 times this year, pointing specifically to the next few meetings, including June. This view was then reiterated by Fed's Lockhart, who said that he too felt that 2 raises was a good base case scenario, and we could probably see 3. So USD bulls are taking this current Fed positivity and running with it at the moment. And you can see that on the weekly chart, we actually just broke above last week's highs on the back of those Fed comments yesterday. And this current positive momentum, if it continues here, if we refer to the monthly chart, you can see that on the monthly chart, we're actually putting in a really strong bullish reversal candlestick. So as we said, the level that we're currently bouncing from, not only is it a big double bottom level here with the lows from last year, the mid-May lows, but it's also right back into this key support area formed at the 2004 and 2005 broken highs. So this is a really important pivot for the dollar, and the price action that we're seeing at the moment is suggesting that we're going to get further rotation higher from this point. So if we drop down onto the daily charts and take a look at the near-term technical landscape, you can see here that we've been moving in a pretty steady bearish channel recently coming into this key support level. However, the bounce that we've seen from that level has seen us take out the short-term bearish trendline resistance. You can see from the late March high here, the bearish trend line has been broken now, and we're currently trading up to a retest of the 38.2% fib retracement from last year's highs, which coincides with these lows and these previous highs. So this is the next big pivot point for the US dollar. If we start to see a little bit of stalling here and some selling interest emerge, then I'll be looking for this interim area to provide some support. So whilst we hold between this level, it still sort of hangs in the balance. We could see a rotation lower. But again, going back to what we discussed last week and my mild dollar positive view, I'm anticipating that we'll actually see a breakout above this level. And then obviously beyond here, we need to start looking at the 50% Fibonacci retracement in line with this bigger bearish trendline resistance. So these are some of the key levels that I'm looking at with the US dollar. But again, for now, I'm anticipating in line with the weekly and monthly price action that we are actually going to see further upside. So how does that translate into the currency pairs that we're watching at the moment? So if we bring up the majors, so looking first of all at the euro, we were looking at the euro last week. If I just zoom in on this a little bit, we were looking at the euro being stalled at this point currently. Actually, no, it was up here, wasn't it? It was higher, yeah. So the euro last week, we were stalled at this key support level, and we were anticipating that we were going to get a break lower. We did actually get that break lower. So the strong retail sales figures for the US last week got some dollar strength into the end of the week, and we saw the euro break down nicely through that level. And if you remember, we were stating a target of this level here at the 112.20 zone. So this 112.20 zone lines up nicely with 50% fib retracement from the March lows, and also this previous swing low. You can see we've got an area here of previous highs and previous lows. So this is good structural support in line with key Fibonacci support. So this is going to be the near-term price pivot for the euro that I'll be watching. So far, this breakdown has been pretty routine. If you remember from last week's session, we looked at that key reversal candlestick as marking the exhaustion of this current bullish phase. And we're anticipating that we're going to gradually grind lower into a test of this channel support. So for now, it's simply a question of watching the price action and seeing how this develops. We've got some good areas to look to set shorts against if we do retest here. Again, at the moment, momentum is a little low. We're not seeing a lot of key data at the moment, so flows are a little bit stifled. But there are some areas that if we retest, we could see some further selling interest emerge. So obviously, we've broken down through this near-term rising trend line, which picked up these three swing lows. We've just broken down through that now. We've broken down through that last price low. And so if we get a retest of this zone, a bounce back up into the underside of this broken structural support, into the underside of this broken rising trend line, then this could be a good area to look to set shorts, again targeting a move back down into this 50% fib level at the 112.20 area. Again, this is going to be the key price pivot for the euro dollar. So if we stall out here and price action suggests that we're going to see a reversal higher, then it could be that we do get that rotation back up into this zone. So this is the level that I marked out in last week's session as well. You can see that we'd have a head and shoulders pattern forming there if we traded back up to retest these previous highs at around the 114.30 level. So again, in the near term, keeping an eye on this pink line here at the 112.20 zone. This is going to be the key determinant for price direction over the coming week. Now, alternatively, if we do break straight down through that level, okay, so if we do push down through that level, and the next zone that we're going to be targeting is, of course, this rising trend line support from last year's lows. So you can see we pick up last year's lows, consider this swing low also in March. And so what I'd basically be looking for is a move back down into that level. And possibly we might overrun slightly and test the 78.6% retracement. So these two areas, both the rising trend line support and the key Fibonacci support, are going to be zones that I'll be looking at. If we bring up the fib from the all-time lows, you can see we don't actually have a great deal of confluence at the level. So the 61.8 is sitting just below it. Again, we've got this previous area of price action, which may provide support. So around this area here, I'll be looking at as a target for this current down move. If we do manifest some further downside, again, whilst we hold above this 112.20 level, there is still the chance that we're going to get a rotation lower. So we really do have to keep an eye on things for now. And again, wait until we get some momentum return to the market. As I was talking about last week, these low momentum periods can be especially tricky for breakout traders specifically, where we're getting these periods of consolidation and then we're starting to test the lows and the highs. But for now, we've been pretty fortunate. The euro has been breaking down in quite a routine fashion. And so for now, I'm simply waiting for the next leg lower, considering this key price pivot. Okay, so moving on to cable then. So the sterling dollar. Again, with the sterling dollar, it was a pretty similar story last week. We were looking at, I'll just drop down to the 4-hour chart so we can see this more clearly. We were looking at being stalled at this level here, okay? So we had this clear support level marked out at the left shoulder and the right shoulder of that mid-March head and shoulders pattern. You can see we picked up some further highs here. So this was a really key structural support level. We stalled out into a test of that level, and you can see we actually got a false break of the level. So I think it was Friday actually when we broke down, traded below that level, and then reversed sharply higher. So again, referring back to what I was saying about having to be extra careful in these low momentum situations where moves aren't necessarily indicative of sentiment in the market, and we get some more exploration in terms of testing the highs and lows of these ranges and reversing. So you can see we got that false breakdown. We didn't touch the next target for the downside move, which was the 43.09 area. We reversed sharply higher, and now we're currently trading back up. So cable at the moment being supported by the moves in risk appetite, the moves higher in oil markets dragging risk assets higher, and cable is tracking these moves at the moment, benefiting from this price action, actually kind of dismissing the fundamental picture at the moment. Obviously, cable has been weighed upon recently by, we had the dovish Bank of England last week who was sounding the alarm bells about the likely negative impact of Brexit, which they say will lead to higher unemployment and higher inflation. The bank also attributed the recent 9% fall in sterling since November last year to the damage caused by investor uncertainty surrounding Brexit. On top of this, we also had weak April inflation figures come out this week, with both core and headline inflation printing below expectations. However, for now, it still looks like the market wants to test higher and is ignoring these key fundamental aspects. You can see we're actually currently challenging a key resistance zone. And again, for breakout traders, this is a level that you want to be watching here. So the 145.27 to 145.44 zone, where we get these previous highs line up. And you can see on the 4-hour charts, we've also formed an inverse head and shoulders here. So what we actually have at this resistance level is the neckline of this bullish reversal pattern. So it could be that we get a move above here. However, for now, I'm going to be standing aside on this because referring back to the weekly charts, which I always start my analysis with, you can see that we're still working off the basis of having that big bearish reversal candle at a key resistance zone. So we traded back up, retested the underside of the broken 2015 low, got that big bearish reversal candle, traded lower, and now we're currently just retracing that candle. So for now, I'm not convinced this is the start of a fresh move to the upside. It does still feel like we're simply retracing that initial sell-off. However, we do have to be cognizant of the fact that we have got the beginnings of bullish structure here. So we've got the higher high, the higher low, the higher high. So this could be the higher low. So we do need to keep an eye on this pair and see where we break out over the next couple of days. As I say, I'm not going to be getting involved on a top side move here, as I'm still thinking that this move will exhaust and we will break lower. However, let's keep an eye on that and see what happens over the coming days and the coming week. Moving on to the dollar yen then. So the dollar yen, again, it's just holding within this clear bearish trend that we've been in for the last several months. The Japanese yen has moved out of the spotlight a bit recently. We're a few weeks past that last Bank of Japan meeting now. And the markets have taken their foot off the BOJ's neck a little bit, with the Japanese yen actually having weakened on improved risk appetite recently. Now, we've got some really clear technical levels in the dollar yen at the moment. And you'll remember last week that I was actually looking to use this level here, the 107.90, so call it 108. I was looking to use that level as support, anticipating that if we got a rotation lower from higher levels, we're actually going to have an inverse head and shoulders pattern forming, indicative of a bullish reversal happening. However, we didn't trade down to that level, and we haven't really forged much higher ground either. You can see that we've pretty much been stalled in this block of price action since last week. We've made our way towards that bearish trend line resistance that we highlighted last week, and we're currently stalled just to the test of that. So for now, and again, suffering from a lack of momentum in currency markets at the moment, we aren't really getting much clear signal as to which side we're going to break to. However, we have got these clear technical levels to monitor, and if we do get out above this current block of price action, and if we do get above this bearish trendline resistance, then the next level that I'm going to be monitoring is this 111 block, and this should prove to be a really key price pivot for the dollar yen. You can see it's a big structural level. We had a series of lows here which held over the beginning of the year, over most of February and early March. We then broke down through that level, traded back up. We retested the underside of those broken lows, and you can see that we had a really big bullish expansion bar here on the daily. However, those moves were exhausted, and after the Bank of Japan meeting, which saw the Bank of Japan keeping policy at current levels, shocking markets, with disappointing markets a bit, we saw that sharp reversal lower, broke down to new lows. However, with current dollar strength and Japanese yen weakness, we're now seeing a bit of a retrace. However, for now, we do still have to consider the fact that we are still moving in this bearish trend structure. And so for now, we have to view this as simply a correction. But going back to what we're saying about the dollar being at a really important pivot point at the moment, and the monthly candlestick presenting a possible key reversal, if we do break out above this level and we get up above 111, then it could be that we see some open water to a test of 115. We do have some further trendline resistance coming in here, obviously a shallower gradient taking in these recent highs. So there are some key levels to watch here on the dollar yen. And again, if we do get this move to the downside here, then we definitely want to be considering this area as providing possible support in line with the view that we might have an inverse head and shoulders pattern in our midst. So that's definitely a level I'll be watching if we rotate lower. But for now, watching for a possible breakout to the top side. Okay, so moving on to the dollar CAD then. So the situation with the dollar CAD last week was that we had just broken out above this bearish trendline resistance, and we were challenging this key price pivot zone at the 130 area. So we had these big weekly lows here that broke down. We got the retest, and so we were challenging this big price pivot zone, and we were looking at that as being the key determinant for whether we broke out higher or reverse lower. Now, we were in fact selling off a little bit from it, and for those of you in the session last week, you'll remember that I actually highlighted this level as being key support. So very similar to what I was just discussing in the dollar yen, what I was anticipating that we could see set up here was an inverse head and shoulders pattern where this previous broken low forms the right shoulder, forms the left shoulder, and then a retest of that level forms the right shoulder. So around the 127.60 mark, back into these low daily closes in early April. So you can see we actually got that pattern play out. Price traded back down, tested the initial support zone here, and we got a strong bounce. You can see on the daily candle, we actually got that bullish pin bar candle, which again is a really key reversal candlestick. We then traded sharply higher, and we're currently testing that big price pivot zone again at 130. So like we were just looking at previously in the sterling dollar, what we're actually seeing at this resistance level now is a potential neckline of the inverse head and shoulders pattern. So if we do get a break above that level, which I'm expecting that we might, then we could look to target from a classic technical perspective, a move up to the 50% fib retracement around the 135 region, okay? So that's the distance from the breakout equal to that of the neckline and the head. And obviously that takes us up to just shy of those big 136 lows, okay? So that was major support at the start of the year, and it was actually the break of that level which provided the catalyst for the subsequent 1,000 plus pip decline. So that's a major level for markets. Definitely going to be a lot of orders up there. So if we do get a breakout above this zone, I'm going to be looking for a move back up to that level. Now, obviously, the route to that level does have some clear obstacles. We've got these recent swing highs at the 131.37 area, and also the 132.73 area coming in with the 38.2% retracement from last year's highs. So we do have some quite sturdy resistance at those levels. But again, if we do get the proper breakout above this neckline region, then that's going to be my ultimate target on the move, a move back up into the 50% fib and potentially as high as those broken lows. Now, obviously, the fundamental landscape isn't particularly supportive of a dollar CAD breakout at the moment, because the Canadian dollar is deriving a lot of support from the developments that we're seeing on the fundamental landscape regarding oil. So there's been a lot of production outages recently around the globe, and we've seen as much as 3.75 million barrels of oil per day wiped off the market. So these latest developments have actually seen Goldman Sachs revising their oil forecast, as they now see oil going into deficit into the second half of the year due to this fall in production and strong demand. So for the time being, we aren't seeing the typical move here, which would be a clear breakout higher. But I think there is still room for a move higher, and obviously the developments in the oil market will continue. So we're going to have to keep an eye on what happens there. But for now, I'm going to stick with a bullish bias in this pair, looking for a breakout of this 130 zone. Moving on then to dollar Swiss, another really good chart at the moment. I actually had a question last week from someone who was long dollar Swiss. I think it was 97.10. I hope you're still holding that because this is looking good at the moment. You might remember last week that I identified, let me just drop down to the 4-hour chart so it's clearer. Get rid of this. Last week I identified this 98 level as being the clear price pivot for the dollar Swiss in the short term. So we stalled out early in May, formed this big double bottom. And again, if we go to the daily chart, you can see that we had this big bullish pin bar candlestick at the double bottom. So this was a really great sign that we were going to get a reversal higher. We then traded back up, and you can see that last week at the point that we were doing the session, dollar Swiss was around this level here, so it was holding just beneath these two highs. So I identified these two highs as being the key price pivot. So if we get above there, I'm looking for a bullish move. If we get price action there that signals a reversal lower, then we're likely just going to rotate back into the lower end of that range. We also had this bearish trendline resistance coming from the year-to-date highs. So the January highs up at the 102.50s level, picking out that mid-March swing high. And you can see actually that just yesterday, we broke out above, just today rather, we broke out above that rising trend line and above that key structural resistance. And I actually gave this trade as a trade alert on the website. So this was a 98.10 buy with a 97.30 stop, targeting a move initially up to the $1 mark. So the trade alerts, for those of you who don't know, we've been running them on the website now since November last year. We issue daily trade alerts with a minimum of 1 trade a day. We also issue another Asia alert trade later on in the UK evening, and we do a trade of the week. So these have been running since November last year. We're currently up over 3,000 pips. So if you're interested in those, please make sure that you check them out on the website. And at the end of the webinar, we've actually got a code that you can use to get a discount on those. So for any of you who are interested in getting these live daily trade alerts, then definitely head to the website and check those out. Okay, so going back to the technical aspect, long on the breakout above this key structure and aiming for a move back up initially into the $1 mark around here. Now, obviously, I'll be keeping an eye on the close today because as with a lot of these pairs and what I've been saying, reiterating these recent sessions, momentum is low in the market at the moment. You can see this breakout has already stalled. So usually I'd be expecting a move above a key resistance level like this to produce a much larger initial move. So the fact that we're stalling already at around that trendline resistance does concern me a little bit. So I'm just going to wait and see the close today. If we close back under that level, then I'll exit this trade for now because that's likely indicative of a false break of the level. However, as I say, I am still expecting that we see some dollar upside from current levels. So whilst we hold above this level, I'm happy to give this trade some room and let it continue to break out, targeting, as I say, a move back up into the 100 mark. Okay, so moving on then and looking at the Australian dollar. So again, the Aussie, last week we were looking at another straightforward breakdown play. So we were stalled at this level here. You'll remember we identified this zone around the early 73s as being a really key support level. So we had these two big prior highs that capped much of the upside over late 2015, stalled those advances. We then got the explosive breakout in the Aussie earlier on this year. So these two broken highs were going to be a key price target. We traded back down into those levels and stalled out. You can see we also had the confluence with the 50% Fibonacci retracement level from the 2016 lows. The catalyst for this bearish move, you remember that we were saying from a technical perspective, whilst in this long-term downtrend, we'd simply retraced back up into a period of really key prior support. So we traded back up into these broken weekly lows, tested quite deeply into that zone, but ultimately failed. The RBA obviously cutting rates for the first time this year, lowering their inflation forecast and signaling room for further rate reductions if needed. So that provided the catalyst from a fundamental perspective for the breakdown. we were stalled at the 50% retracement level, having seen these really volatile expansions to the downside. And so again, as with the euro and cable, I was simply looking for a breakdown through the lows to provide the next leg down in what I see as being a straightforward breakdown. Now, you can see that we did actually get the breakdown below last week's initial lows. However, we stalled out, retraced higher, and retested the underside of that resistance line. And again, going back to last week's session, this was another move that I was anticipating. So whilst we hold below this resistance level, I was expecting any retest of that level to see decent selling interest emerge and provide the catalyst for a further down move. So for now, I'm still looking at the Aussie as being a straightforward breakdown play. We are getting closer to what I see as being the next key support zone or the next target in this down move. And that is around the 72.50 zone, where we've got these previous highs. And this block of resistance here, these three highs, you'll note that these were actually the last highs made in the Aussie before we got that explosive breakout earlier on in the year. So a return to this level is likely to see some profit taking and some buying emerge. We've also got confluence with the 61.8% Fibonacci retracement from the 2016 lows. So again, looking for a breakdown below this week's initial low, but cognizant of the fact that in the short term, I think we're running out of room here, and especially while momentum is so low. If we do trade into this area, I struggle to see us breaking down through that area initially, unless we hold this level for now and stall out around here until next week. Obviously, we've got Australian unemployment rate data coming up before the end of this week, so that's going to be a key short-term catalyst for rate. So if we do get a miss on that figure, if we do get a worsening of Australian labour market conditions, then we could see that breakdown manifest this week. Now, again, if we do get a move back up, okay, so nothing's set in stone, although I'm anticipating that we continue to move lower, we could see the Aussie reverse higher from here. If we do reverse higher, then obviously this zone that we've just highlighted, this 73 to 73.50 zone, will provide decent support again. In terms of resistance on the upside then, you can see that around the 75 mark, we've actually got this ledge of previous broken lows. So all of this prior support that was brushed aside on the breakdown, this is likely to provide some decent selling interest if we trade back up. So again, in line with my view that the Aussie is going to break lower, if we do trade back up to that level, I'll be looking at that zone as an area where a price action signal could give a good entry to the next move down in the Aussie. So as with the other pairs, still struggling during this low momentum period at the moment. There's a lack of clear directional catalysts. Obviously, the US dollar still being supported by these Fed comments, but not a lot else on the data calendar for the rest of this week. So it's really going to come down to next week before we get any return to data-driven volatility. But these are the levels that I'm going to be tracking for now in the Aussie. So I'll just highlight this zone again, the 72 to sort of 72.50s. We've made that initial test of this zone now. So if we do delve deeper into that area and start to test down to the bottom of it, then we could see it pierce this zone and break down. So you need to keep an eye on price action here, especially with the Aussie unemployment data coming up before the end of this week. And then finally, moving on to the New Zealand dollar. So the New Zealand dollar last week, we were noting that we had the failure, this big double top. We'd sold off, we'd had a really sharp breakdown, and the breakdown had actually seen price break down through rising trendline support formed from the year-to-date low. So we had the January low, picked up the swing low here in mid-March. We then broke down through that level last week. And at the point that we were discussing this chart last week, we were hanging out around this zone here. I think we'd actually made some minor retracement, but we hadn't retraced up to this 68.30s level rather. So remember from last week, this was the level that I highlighted as being a really key structural level for price. So it's where we had that initial high close on the rebound last year. So after being stuck in this long decline, we got that really sharp rally high, and the high close was capped at that price there at the 68.30 zone. We then traded up, had a big double top at that level, failed and traded lower. You can see that when we traded back up to it again we found resistance. And looking at this previous block, this most recent block of price action, you can see just how important that level has been. So we had resistance, a breakout, support, a breakdown, resistance, a breakout, support, 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 a breakdown. So I was anticipating if we got a move back up to test that level, we're going to see selling interest emerge. And you can see that's what did happen. We traded back up, retested that level, and then immediately spun down by 90 pips or more. Obviously, we've got further resistance at this level with the rising trend line, the broken rising trend line. So for now, again, with the Kiwi, I'm simply looking for a breakdown below this low. So in line with the breakdown from the double top, the break of this key structural level and the break of this rising trend line support, I'm anticipating that we do see some further downside. Now, obviously, this chart is a little bit messy at the moment. You can see that we've got a lot of congestion going on where we had this previous grinding range in the Kiwi dollar. But whilst we're below this 68.30 level, I'll still be monitoring price action, looking for a breakdown below this level. And ultimately for this move, I'll be looking for price to come back down into this zone here. And this was a really important, a really interesting level in the Kiwi dollar. So the 65.40s to 65.50s, we were capped there at the start of the year. We got the breakout, we got the retest. So this was a really important pivot point for price at the start of the year. And so if we trade back down into that zone, I'll be expectant of some buying interest emerging there and definitely some position squaring on the short side. So again, for now, anticipating that we get a break lower. Price action on the lower time frames still looks corrective to me. So we've still had this impulsive move to the downside. We're now getting that corrective ABCD formation here with the overlapping legs. So whilst we can stay below resistance at the 68.30s level, I'm still comfortable expecting that we're going to get a break to the downside. Obviously, if we start to put in some trend lines here and map the recent moves a little bit, you can see that we have some trend line support to monitor. And so this could be the initial heads up that we're going to get a break lower. On any move below this trend line support, we can then look for a breakdown below this 67.40 support, and then finally below the 67.16 support. Next key area to watch with the Kiwi ahead of that ultimate target is obviously going to be the 50% retracement from the year-to-date lows, which comes in just ahead of this big swing low here. So this zone here between 66.70s and 67 is likely to be one of support for the Kiwi. So we'll have to watch the break of this level and not get drawn in on playing the first breakout, because what we might actually see here is a failed breakdown and sort of a short-term double bottom that provides a bounce. Again, momentum is still slow and we're into this period of heavy congestion. So it's not too clear that the move is going to be a straightforward breakdown. Although, as I say, again, whilst we hold below this 68.30s level, I'm going to be targeting a move ultimately back down into the 65 zone. Okay, guys, so that's it for this week. I hope that's clear. I hope you've got those levels marked out in your charts and your understanding of the fundamental aspects that are driving price action at the moment. As I say, in the meantime, please make sure to head to the website, check out the live trading room where we're sharing institutional research and desk commentary on a daily basis. We've got the daily trade ideas, which are up 3,000 pips since November. We also do daily Forex reports, as well as all of our great educational material. And here's that discount code that I was talking about, LFX Street 16 for 10% off the trade alerts. Okay, so thanks a lot for tuning in today, and I'll catch you all next week. Have a good week and good luck trading.